The dollar-yen pair has been a battle of the safe havens over the last few months. Anytime we've seen risk aversion in the markets, the dollar and the yen are two currencies that tend to get a flood of cash. The US dollar, of course, it is the world's reserve currency, so that's naturally going to lend itself to its safe haven status. But also, interest rates being so high in the US compared to the rest of the world mean that treasuries are naturally in demand as well because of the higher yield that they have on offer at a time when everywhere else is yielding so little. We're looking at Germany and others as a prime example of that. But the yen is a traditional safe haven as well. So when we do see this risk aversion in the market, we do seem to see the floodgates open and money pours into the yen. And as we can see on this chart right now, when we have seen risk aversion in the markets, the yen has reigned supreme in this case. We pull back towards those 105 levels previously during that risk averse period in the markets, and we have seen a rebound into the kind of 108s, 109s. And what's interesting about that rebound so far is that that's taken us through, as you can see on the chart here, the Ichimoku cloud. Now, the Ichimoku cloud is quite simply a bullish and a bearish signal. If the pair is trading above the cloud, it's in bullish territory, and below the cloud in bearish territory. So we broke through that and found resistance around the kind of 109 levels. Now we're coming back here around the kind of 106s. Now this is where price could potentially interact with the cloud again. It's worth noting that the lagging line on the chart is yet to break above the cloud. That's seen as the confirming indicator as far as the Ichimoku is concerned. And therefore 106 could be very interesting. If price holds on the 106, so we get that further confirmation, that could be followed by the lagging line piercing through the Ichimoku cloud, and that takes us officially into bullish territory. And again, in terms of levels above where we are now, 108 has always been an interesting level in this dollar-yen pair, but with 109 having been the most recent peak, that is naturally a potential area of resistance, and 110 being a big round number could potentially be another major hurdle. If we do see a break back below 106 though, then 105 starts to look very interesting once again. Historically, this has always been a very notable level of support, and I think if that's broken, then that could be seen as a very bearish signal, and all of a sudden people are talking about that key 100 level once again. It's worth noting that apart from risk, there are a number of other factors that are impacting this pair. One, of course, is the Federal Reserve and the pace at which it's now cutting interest rates. Markets pricing in a high probability of another rate cut this year, potentially as early as the next meeting. But the Bank of Japan, which has actually effectively been on hold for a number of years now, it's rumoured that they are also now looking to cut interest rates. Interest rates there are currently minus 0.01%. Now, if we do see a rate cut there, this will be the first rate cut that we've seen in a very long time, and markets are actually factoring in around a 50-50 chance on the 31st of October that they will cut interest rates by 0.2%. Again, Bank of Japan has been very reluctant to move too deep into negative territory, as we are seeing in other countries like the Euro area until now. But it seems that the experimentation has been done, and they are a little bit more comfortable, it seems, to pursue further negative interest rate policy. So again, that meeting is going to be key. But what it means is that could lend itself to a little bit of yen weakness, which has possibly helped lift it off those floors so far and driven the pair through the Ichimoku cloud, and could be that confirming indicator which drives the lagging line through as well.